Welcome to Trading Growth and Value Stocks. My name is James Boyd. We welcome you here today on this December 10th, 2 weeks out to Christmas Eve. Let's go for it. We also got Scott Thompson in the chat. You know him. He teaches later on today, and I'll show you that. We welcome him. And we'd like to welcome everyone here. We've got Bill with us, Will, Jay Richardson, Greg, Paul, Ocean Life 2026. Let's go ahead and hop right in. Welcome to all. Now remember, just real quick, there's my handle on X. We all of us coaches post on X. We do post announcements there. Speaking of announcements, right off the bat, want to make sure that you're aware of tomorrow night, there is a special webcast that they're actually doing. And it's called, and some of you have asked about it, regarding the 2026 market outlook. Now, you're going to see that it's done by Liz Ann Saunders, Kathy Jones, Joe Mazzola, Colin Martin, and Michelle Gibley. Let me send this link out to you, because when I was doing chat this morning, there were some questions on where do you find it. Sent that link to you. You're going to see that if you said watch live, you click on that link right there, it's going to hyperlink to schwabnetwork.com. If you're on the Thinkorswim platform, you could also go to Trader TV, just click on the Schwab Network, and it would also show that as well. So either way, if you're on the platform, if you want to go to the website, there it is. There's the link. And it's also going to show some of the content that they'll actually discuss as well. So quick heads up there. Join us. That is going to be what time? Tomorrow night, 7 to 8 p.m. Eastern. Okay. Now that 2026 is right around the corner, so buckle up. Now just real quick, this is Fed Day. Today at 2:15 Eastern, maybe closer to, let's say, about 2:15 Eastern, we'll get the rate decision, expected rate cut of 25 basis points. Right around 2:30 Eastern, Fed's Jerome Powell will start talking, probably say the same things he did before. But a lot of investors like to kind of see what's the forward expectation regarding rates, employment, and inflation, and so on. So that's also on the network as well. So join us there. Just real quick as we get going here. Remember, the information is provided for general informational purposes only. This class will talk about fundamentals. We'll talk about technicals. Today is our real focus that we're going to discuss is looking at really things from a fundamental relative perspective. We're going to look at some stocks and then compare them to other stocks fundamentally and technically. And we're going to really be focusing a lot on Schwab.com website here today. Now, we also remember that when we talk about the examples, we'll do those examples right in the Paid Money software application. Also understand that there's risk associated with dividend-paying stocks. We know that dividend-paying stocks, they're not contractual. They could actually cut the dividend, some, all. They could raise it, okay? It's not infinite in time. So the biggest actually thing is remember that. Also remember that investing involves risk, including loss of principal. And also remember when we show examples, they are just that. So first off, I want to kind of take just a very quick look. Kevin and Rachel talked about the market this morning. I don't want to rehash that, but I do want to kind of just emphasize where we are right now. When we started the week, we talked about the VIX moving to the upside. I want to start there for just a second. Now remember, the VIX moving to the upside, if this chart is actually crossing to the upside, what do you think equity markets are doing? What do you think they're doing? If this chart is actually going up, if the expected forward-looking estimation is that the market might become more volatile, what does rising volatility typically mean? That typically means that if I looked at, let's say, the S&P 500, I'm probably going to see the opposite of this chart. So if this was bullish, that actually probably means that the S&P is probably maybe going the opposite direction. That is very important, okay? If we see the prices below the 10-period moving average, we've said over and over and over, but it doesn't matter. It doesn't matter how many times I've said it. The question is, do you get it? And if we get below the 10-period moving average, we're losing momentum. You lose momentum. And all of a sudden, we actually go from a green moving average to a red one, and then we get a moving average crossover to the downside. So now we're actually talking about the short-term moving average getting below the 20-period moving average. Is that a bullish signal? Sharon, Pia, is that a bullish signal? David, Silas, is that a bullish signal to you? If you're now looking up at the 10-period moving average, you being the price. If you're now looking up at the 10-period moving average, looking up at the 20-period moving average, is that a bullish signal? No, it's a signal that the market's raining right now. We actually, now, by the way, so think of if we said the SPX, let's think of it as 2/3 of the stocks that we could look at might look like the S&P 500. Okay, so the moral of the story is this is why we kind of talk about the strategies that we did. Okay, we talked about that, right? Changing the strategy. Once we kind of see the market kind of becoming a little softer, up near resistance, some investors might change strategy. Hit that last Monday, hit it the last couple of days. Here we are still. The biggest thing is when we take a look at, let's say, the NASDAQ, is that showing the same condition? Looks the same, okay? Crossed over to the downside. Now, does that necessarily mean just because it's raining, so to say, meaning price down below the moving averages, maybe crossover, does that mean it's bearish? Well, shorter term, it does, right now. Does it mean it's intermediate to long term? No, it's just short term. We're just kind of pulling back, consolidating. So that probably means if we're just being brutally honest, okay, there's probably less stocks than more that are actually moving to the upside, okay? If someone actually sees that condition, they're buying a stock with headwinds of the market consolidating and or pulling back. Dow Jones, what do we see there? And we see the Dow Jones has also crossed over. Maybe not as bearish as the other ones. S&P and the NASDAQ doesn't look hasn't pulled back as much. And the one that has done a better job in terms of relative strength, it's pulled back, but it just hasn't pulled back as much, okay? So you actually have in that one on the smaller caps, the Russell 2000 with both moving average lines still green. However, its price is still below the moving averages. So this is why I said on Monday, when we see this, it's kind of like cautionary signs, okay? A, you're up near the area of resistance. 2, the price is down below the 10-period moving average. 3, the moving average actually starts to cross. And 4, the price is up, looking up above both moving averages. Just kind of caution. So sometimes you don't always get super bullish. Now, you would sure hope that after today, that the market listens to what Fed Jerome Powell and the group actually says in terms of forward interest rates, employment, inflation. And you would sure hope that this is kind of like that decision point where you can set the expectation and investors over the next 2-3 days become a little bit more comfortable as far as what the Fed wants to do and guides the market. Kind of gives us an idea of maybe what the cost of capital could be. So if we said, is the market bearish intermediate to longer term? No. Shorter term, more consolidation, though slight pullback so far. Now, what I want to do is I want to kind of just pull up just real quick. Why don't you just pull up just real quick? Where's gold at today? Down 13, nothing major, 0.3%. Where's silver here today? Silver overnight, if you slept, did tippy toe over 62. But it just depends on when you're watching. Probably right around about 9 o'clock Eastern last night, it hit that. Okay. Now, I want to kind of take a look at a couple stocks. And what I want to do is I want to pull up a stock. I want to start with just real quick Apple. Okay. Now, we said yesterday, Apple's kind of down near this old horizontal resistance, new potential support. Now, some investors, not all, some investors like to kind of maybe try to get in. If the MACD is actually down to some extent, that actually might mean that the price might be down near this old, well, current low, near the old highs. What I want to do right now is I want to go just real quick to Schwab.com. And what I'm going to do now is once we go to Schwab.com, I'm just going to type in the symbol. Now, we can go to Schwab.com, need to log in. We're going to click on that little search icon right there. Type in AAPL, okay? AAPL. When we actually do that, it's going to give us the stock symbol. We want to click on that now, okay? So go to the search icon, top right, there. Type in the symbol we want to look at, Apple. We're now going to click on the symbol Apple itself. Now, a couple things that I want to point out here. The purpose of us looking at this, we want to kind of see Apple, its strength, A, and then 2, we actually really, or B, we want to really kind of compare it to other stocks in the group. Now, I'll be honest, we ain't just looking at Apple. We're looking at the stocks that are also in the group. This is just like real estate. If you found a nice home, there's a really good chance that there's not just one nice home in the neighborhood. The neighbor's house might be nice too. And the neighbor's house might be nice as well. Let's go look and see what we can find. Well, if we go down a little bit to the bottom, we got the information on the chart, we got news, and now we're going to go down into dividends. Nothing major in terms of the dividends. Pretty consistent there, historically speaking. And by the way, if we're talking about annual dividend yield, Apple does not share their earnings that much in the form of a dividend. Noted. If we click on where it says show more right there, show more, we can now actually go see over time. Okay, you're going to now see that over time, what those dividends have really been. And this goes all the way back to 2017. So if you are a dividend person, do not forget, okay, to click on that like we did. So if I went back just real quick, okay, how do we get that? Click show more. And by the way, a lot of us are dividend investors. We like to actually use assets to try to actually get a form of income, okay? Always remember that those dividends, they can change. Now, the biggest actually thing is when we look at Q1 earnings. So when we look at Q1, you're thinking Q1 is in January, right? A lot of Q1s actually start in October, November, December, but then they're reported in really 2026. So what you're now going to see is think of Christmas sales or holiday sales. There it is. So there is some seasonality to the business of Apple, which really isn't that surprising. New iPhone, new iPad, new computers, and so on. The other ones, it's not the same. So a big chunk of the sales is actually coming in Q1, which is fall of 2025, reported in 2026. Now, when you actually look at the estimates, okay, dark blue, actual, we can see that actually over time, historically where those earnings have been, fine. We actually see, for example, we see revenue size, TTM, trailing 12 months, 416, price to earnings, still pretty high at 26 with a forward PE of actually 33. Now, wait, does anyone know why the forward PE tends to be always lower than not always, but tends to be lower than the price to earnings? Does anybody know the reason for that? Well, so we got the price, the numerator, right? Price, and the earnings per share on the denominator, the bottom. Why is the forward PE almost always lower than the price to earnings? Well, at least you'll hope it is. It's because that earnings per share you hope over time is going to increase, and it's going to be a bigger denominator, and so it's going to make that forward multiple, the PE multiple, lower. Okay. Now, is that always the case? Well, that wouldn't be the case if they're expecting the earnings per share over the next fiscal year to be lower. Okay. In that case, the forward PE would be higher. So the question has been on that. Just wanted to address that. PEG ratio of 3.16. Now I want to kind of get into just real quick what I wanted to show. And there's a couple stocks here that we want to highlight right off the bat. Number one, we're going to take a look at Apple. Number two stock we actually see in here is STX, Seagate. I don't know why I think of Seabiscuit, but let's go Seagate, okay? And now what we see is WTC. Now what we're going to take a look at is, you know, when you look at stocks relative to their companies, their industry groups, there can be a massive difference. Massive. So when we talk about market cap, we're saying, look, if we took the common shares of stock times the number of shares outstanding, what's the value of all those shares outstanding? $4 trillion. You look at Seagate, not Seabiscuit, 61 billion, 57 billion. So we're nowhere near what Apple's is. Nowhere near. Okay? Big difference. Now that's probably going to be the difference maybe in volume on the stock, maybe in terms of the derivative as well, maybe. When we look at the differences, price to earnings, their Seagate and Apple is close to it, and WDC is trading it only at a multiple of trailing multiple of 22. Now, when we actually look at dividends, they're all three not that much. But this is when we start to kind of get into something interesting. When someone buys the stock now, today, are they buying the stock for where it's been historically? To get some track record, we could say that's true. But they really want to know, what are you maybe going to do for me potentially in the future? So when someone buys a stock today, it's actually what they think the stock could do. Well, what that stock could do is expressed right here, earnings per share growth. The key word is not actual, forecast. And sometimes what you're now going to see is they're going to say, look, what are these profit margins? Why does that matter? Well, because the profit margins actually determine valuation. It's also kind of showing, you know, is there a premium for the product that they're actually selling? Are they controlling expenses? The net profit margin is also, if we're talking about valuation based on earnings per share, then it could actually affect, do they actually pay a dividend and so on. So that's a big deal. When we actually take a look at the companies that have the highest net profit margin, it's Apple. Second, actually, the strongest actually earnings per share forecast, 14%. You're going to notice that sometimes we don't have all the boxes. Sometimes there are companies that do not give forward guidance. So you need to understand that. They don't give that guidance. They might only got a year or so, okay? Now, I want to go back to just real quick. What do these stocks look like? Well, we saw what Apple looks like. Let's go to just real quick what STX looks like. What does that look like to you? So if I were to ask you, Nora, Dragon Rider 108, what does Seagate look like to you? Does that look like an upward trend? Okay. If we looked at the other one in there, WDC, does that look like an upward trend? Now I know what you're thinking. Well, how do we know it's going to go up? You could always say that. That's never going to change. Okay. Now what I'm going to do is I'm going to go back and look at this for just real quick. So when we look at these, I want to go to the valuation column, and this is going to be a part of your homework. Okay. So if you go to valuation, what does valuation show us? Well, valuation is actually really showing us the price multiples. Okay. Now this is not new. You go to the gas station and you're buying price per gallon. You go buy a home, you're looking at price per square foot and so on. Okay. But here we're not talking about price per gallon. We're saying price to earnings. We already said before that if someone says, I'm trying to buy a lower price multiple stock, that is going to be WDC, okay? If we look at price to sales, we're talking about revenue, not earnings, that is actually WDC. If we said which company actually pays the lowest dividend, which actually might have the highest potential growth, that is actually WDC, if we look at the first three. Now, if we look at, let's say, the fundamentals, what does that show us? Well, this gets back to the margins, okay? Net profit margin. Well, now, by the way, that's just looking at the income statement, right? Net income over sales. When we take a look at return on equity, now we're talking about the income statement, net income over equity, which is coming off the balance sheet, which, by the way, Apple's actually had a pretty big number, confirm that, and WDC is not a small one itself. Any of these numbers over 18% would actually be something pretty strong. Sales per share, long-term debt to equity. Why does that matter? Well, that's going to affect your margins. Okay, higher the debt, lower the potential margins. When we look at the dividends, we already talked about that a little bit, and I'm going to come back to that in just a second. I'm going to look at, so if you had to choose between one of these three, Apple, STX, or WDC, which one is kind of standing out to you a little bit? I don't know why, but that WDC is kind of standing out a little bit. Okay, now I want it, before we go to that chart for just a second, the payout ratio. Think of the payout ratio as what percent of their earnings are they paying out in the form of a dividend expressed in percentage? Well, WDC hardly shares anything, okay? The dividend coverage ratio is, what's the dividend compared to the net income, okay? The higher the coverage ratio, the safer some investors feel like it could be. Why is that so high? Well, it's the net income over the dividend. The higher actually that the coverage ratio is, the safer it could be at the point of time not to alter negatively, okay? Now, the total dividends paid, why is that coverage ratio so high? Because they hardly pay anything. So when you think of that dividend coverage ratio, it's the net income over the dividends paid, okay? Now, if we take a look at this, let's go to WDC for just a second. Now, in the world of technical analysis, and I just want to kind of show this, and it's important here. If we actually go to a class, now Scott Thompson teaches a class on stock investing for beginners. And it actually goes over like what would be examples of basic buy signals, okay? Now, those buy signals doesn't mean you have to buy, but it's some investors, some rule sets for some investors that they might use in the paper money account and so on. So if you said, I would like to kind of get more clarification on what those setups could be, boy, that'd be a great class for you right there. By the way, that's today at 4 p.m. Eastern. Now, the biggest actually thing is if we go back to this chart, we're going to right click. Now, I'm going to do this. I'm going to go back to the paper money account, And what I'm going to do is I'm going to type in the WDC. I'm going to right click on the ask price. So I'm on the trade tab, typed in WDC. That's not too bad. Right click on the ask price, and I'm going to go buy custom, and I'm just going to go with stop. Okay. So when we do buy custom with stop, it defaults to, we don't have to buy 100 shares. It defaults to 100 shares. We're selling 100 shares. Now, just for time's sake, okay, I'm going to say that we're going to buy about 25 shares of stock. Why did you say that? Well, if we buy 25 shares of stock, and if we did that, and that stock is about $173, 25 shares, it's going to be about $4,300 of capital on a portfolio that's right about $40,000. That means that we're about 10% in one position. Now, I probably need to push that down just a smidge, 23, because we're not wanting it to be more than 10% of the capital of the portfolio. Now, number two, when we actually come back and look at this chart and say, where do we see that support area? There's really a diagonal line that we can see on the chart. We got a low there, and then we actually had a higher low there, and we're trying to carve another higher low. Now, do not forget that you can look at these little green dots. 1, 2, 3. Now, I can't see the 3 because your line's in the way right there. We could almost draw a line connecting 2 of those or 3 of those. That can also be the angle of that diagonal line or horizontal line if the stock was sideways. What I'm going to do is I'm going to set my stop right underneath that green dot right there, okay? 165.53 less 2%. It's going to give us 162.21. 162.21, if I go back and put that in, 162.21. All right, now, why would we actually want to really look at this, though? What is it? What's the point? Well, the point of us actually looking at this is we want to kind of see what are the forward estimates. Yes, some investors buy for the history, but what we really want to know is if we go to profitability, we want to kind of see what these margins are, that what they've been over time. Okay, yes. But the biggest actually thing is also, if I go back to overview for just a second, overview, if we want to see this more on a table format, okay, all at once, let's go to show more. And this is what we really want to get to, right? So now what's going to happen is it's going to show the stocks on a comparison basis. Same stocks, right? Apple, Seagate, WDC. But now these individual tabs, they're all put together on one page. There's the fundamental tab we clicked on. There's the valuation tab we clicked on. It's just all on one page now, okay? Now I'm going to go down to really just real quick look at below. This is what we want to see, okay? What is the annual growth? Again, whenever we talk about annual growth, it's going to show us the historical, which some investors might want to know about, but what is the forecast, okay? Why do some stocks go up more than others? Well, usually it's because A, where they've been historically, but 2, it's also what is the forecast. Now, you got to remember, these companies will state what their forecast could be, and they got to really see over time, can they hit it? Number 1. And 2 is, do investors technically buy the stock with the expectation that the company gives, or the analysts actually give? The one that actually has the biggest one-year forecast, earnings per share, is WDC. If we look at the 3 to 5 year, they don't give a forecast. Okay, and you're going to see the only one that actually really gives a forecast is actually STX on a one-year forecast. They also feel comfortable enough to give that forecast over the next 3 to 5 years. Okay, now when we actually go down and look at the bottom here, there's the dividends again. We showed that. Again, instead of clicking on the tabs, we actually can see it on one page. And now you're going to see the profitability. Okay, again, why does the profitability matter? Well, because that's telling us the net income. Why does the profitability matter? That's telling us the earnings per share. We don't know any of those. We don't know if there could be dividends. We don't know what the valuation is going to be. We can't see on a per share basis what that metric is. So that's very important, the profitability. Now, if I scroll down, we can also see things like financial strength, which is now getting into your balance sheet. Now, by the way, the financial strength is huge. Does the company have liquidity to run their business And also, are they solvent? Are they running into debt problems that could actually make their business contract from an earnings per share perspective? And also, could they be selling their assets, which could actually hurt their income? Okay. So this bottom piece, very important. I mean, if you kind of ever think about something like, hey, how does debt affect a individual? Tends not be good. Second, an increasing amount of debt, unsustainable relative to the earnings. It's the same thing for the company. Okay. Can they actually sustain that? Now, what I want to do is we're going to show the example of both. Okay. So we're going to actually buy really WDC for what we think that stock might do on a longer term, shorter term basis. And what I'm going to do is go data GTC. Okay. Confirm and send. There it is. Now let's kind of reemphasize how that stop works, right? So let's say the paper money account buys the stock. Now, by the way, the stock's up 50 cents since we talked about it. Should have stopped talking about it, just put the order in. But we want to walk through kind of what that table looks like. Remember, if the stock is purchased, the stop is a trigger to be sold. It's triggered to be sold, but that's not stating what it's going to fill at. That's the trigger to sell, okay? Send the order, and now what you're going to see is why is it not filling? It's not filling because the stock is up a little bit more than where we were when we first talked about it, and we can see where that is. Now, I'm going to see in the next 2-3 minutes if we can get that price to move down about 60 cents or so, but that's where it is on the chart. Now, this is showing like a continuation pattern. You might kind of have a forward estimate price-wise, what you think that might do. And if you look at this on the right-hand side, let's take that off percent, and it's going to give us a dollar amount. What is your forward estimate? Doesn't mean it's going to happen. What that potential could be. All right. Now, what I'm going to do is type in that number. If we were going to kind of give a forward estimate, what we think that number might be, you got 140 at the bottom. You got about 170 resistance. Someone might say, James, could it try to go up $30? You go up $30 higher than 170, you're talking about a $200 price projection. Now, go back to STX for just a moment. When we look at STX, we're going to look at this as kind of more, that was the example where they gave not only a 1-year guidance, but a 3 to 5 year guidance, okay? What I'm going to do on this one, I'm going to right click on the chart. I'm going to go to with OCO bracket. If we did with OCO bracket, we are putting on a target. Now, I want to kind of just speak to this real quick, kind of like what's happening today, right? Today we got the Fed. They're going to tell us what the Fed funds interest rate is, etc. And then throughout the month, we get this economic data about the economy and so on. Well, the economic data can influence how the company is doing, okay? Fundamentally. That can also influence, when we say it can influence it fundamentally, how strong the economy is, then can actually relate to or domino into how the company is doing fundamentally, the sales and the earnings per share and so on. That can also affect the sentiment of investors technically, price-wise, trend-wise, and are they willing to buy the shares? So it kind of meshes in together. Now, what I'm going to do is I'm going to unlink this. So when I unlink this, as we talk about this, the price is going to move. Okay? Now, what I'm going to do is you tell me what you think that target is. I'm going to go data GTC. What I'm going to do here is instead of actually just doing one share, I'm going to go to not percent, I'm going to go dollar amount. We're going to say that this paper money account can purchase $4,000 of share, $4,000 of stock, which is really going to be about 13 shares. Well, I'm going to round down now. I'm just going to say, look, we're going to buy 13 shares. 13 shares, about $4,000, 10% of the portfolio value. Tell me where the target is, because I'm going to type that number in there. Underneath us, just like we did before, I'm going to take that 275.77 less 2%. It's going to give me 270.75. 270.75. Now, when I'm looking at this from 291 down to 271, I'm really thinking not in terms of just dollar amount, I'm thinking about percentage. Because if we buy a higher price dollar stock, it's going to be a bigger dollar amount. So in my mind, I'm thinking like, well, what is it? Well, from 291 to 270, it's $21. Well, how much is $21 of that entry price 291.94? Answer, 7%? Yeah, 7%. So, and that's important you do that, because if you buy higher price dollar stocks, and you look at the per share risk you're taking from the entry to where the stop is, which that's not the actual risk, that's the forecasted risk, assuming you could get stopped out there. Okay, we talked about that. And when we talk also about the target price, where's the target? Well, if we were to go back and look at this chart, now, by the way, I'm going to kind of take this even from a Fibonacci point of view. If I say, look, the old high, the old resistance was there, the recent pullback we actually had was there, could we extend higher? Well, if we're talking about extending higher to that 161 extension, I'm going to put a target right around about 325-ish. Now, why did you do 320, 325? Well, I just took the extension target, shed about 1%, because that's just an area of resistance. It's an area, okay? We're also trying to say, look, if other investors actually see the same number or draw a line very similar, they might put a target right there. The paper money account is trying to get out ahead of everyone else's targets being hit. That's why it's a little bit less, okay? So it's trying to get ahead of the line of selling that might happen right up near that area. We're going to go confirm and send. Got a target price. Now remember, this is like the stop in a case that is saying sell it if it triggers over the price of 325. If we wake up one morning and we find out that Bill Gates bought Seagate Technologies for $400 a share, could that price get filled at a higher price? Yeah. Okay. Now, that would be wonderful. Not planning on it, but let's say it did. Vice versa, if the stock announced we have massive debt problems, we're going to have to slash the forward guidance on earnings, and we think it could affect our sales. Oh my gosh. Okay. A stock gaps down to 240. Could that fill be a lot lower? Yes. Okay. We're now going to go ahead and send the order. There it is. Putting it right there. Now, I want to go back to just a couple stocks for just a moment. So the paper money account has Apple. The paper money account actually has Seagate. The paper money account actually has WDC. So it's a little locked and loaded in those areas. Now, that could be good or bad. We're about ready to find out. Now, I want to go back to one other stock, Google. Okay? Now, Google has historically kind of been in the land of nowhere. But all of a sudden, when Pia started talking about it, Pia, just say you talked about it. All of a sudden, just Google starts going to the upside. I don't know if you've recognized this, but Google, okay, and you're probably on their search bar every day, that stock, for example, from the breakout area is only up 56%, okay? And we said this before, money doesn't buy happiness, okay? For some people it does, for some people it doesn't, okay? But it's only up 56%. Now, we could have said here, it's at the high, it can't go any higher. It's up at the high, it can't go up any higher, and it's up at the high, it can't go any higher. The problem is that if we said that language, we have no understanding of how a trend works, okay? Now, the stock actually could be going up higher because the company is bringing them in more money. Now, think about this at your job. If you did more and more work, do you think the company might consider paying you more? I wonder if you were actually doing a lot more work, maybe even doing a higher categorization of work. Do you think you might have the foundation to say, boss, manager, whatever, I deserve more? Okay, no, it's the same idea with stocks. Stocks are actually, these companies are saying, look, if we bring more money to the table, and maybe that money is in the earnings per share, free cash flow as well, and we could actually also say that, hey, we have more, and we might even raise the dividend. Well, all of a sudden, these investors are saying, keep talking. Okay, now, what I'm going to do is let's go back down to Google for just a second, and what I'm going to do is I'm going to take one of these stocks out. I'm not going to take one out, and I'm going to type in this Google, And if you don't mind, I'm going to put a little Cisco right here. Okay. So what's nice about this is you could put in some of the stocks that you want to see. Now, by the way, this is part of your homework. Now, here's the deal. Do you have to do this? No, you can do whatever you want. Okay. But I would like you to pick some stocks to practice using them on this Schwab.com, where you can look at these stocks on a side-by-side basis. Now, when I type those in, Google and then Cisco, it's now going to give us these 5 stocks side by side. Now, I'm just going to kind of scroll down. It's going to show us the price performance difference. The biggest one has actually been WDC, color-coded there, and Seagate Technologies. Yes, you thought about Seabiscuit. I don't know why. The third company that has also been up quite a bit based upon a 6-month performance is really going to be Google right there. Now, if we scroll down, let's kind of look at some of these fundamentals for just a second. Now, here's the deal. When you look at Google, that's not a slouch, okay? You're talking about 32%, okay? And this is really a company. So if we have those net profit margins, net income over sales at 32%, that's not small. Now, one of the things we'd actually have to say really on Google is the long-term debt to equity, it's a low percentage on the most recent quarter. Now, is that a bad sign or a good sign? Well, you actually have less debt. I mean, if you had less debt, your net income is probably going to be higher because you didn't have the payment of interest or the payment in general. It's not a bad sign. When we talk about the return on assets, still a pretty healthy number, second highest. Return on equity. And this is for a large cap company. They got 35%. Okay. When we also talk about, when we look at these numbers down here, price to earnings, 31. Now, the fallacy is that if we said, oh, price to earnings 31, it's not necessarily worth that. Well, you'd have to actually see what the justified price to earnings should be, trailing and forward. There is what's called a justified number. And that number might be justified based upon what the trailing earnings has been and the forward earnings has been. The price to sales is actually a little higher. Same thing as price earnings. It could be justified, though, based upon its sales. Now, if you take a look and we scroll down a little bit, you're going to see that kind of, let's look at these numbers going forward. Now, remember, when we're talking about Google, we're talking about a company that's been around for a while, okay? And when you look at the earnings per share growth forecast of 1 year, you're forecasting 31%. That's the third highest on the list behind WDC and Seagate. When we look at this, we do have actually a number that earnings per share growth 3 to 5 years of 18%. Now remember, that's not sales. That's earnings per share. Okay. Now, could you find out maybe what those sales growth forecasts could be? You could. This just really gives us, in this case, the sales growth 5-year. Okay. That's the historical. Okay. Now, if we go down and say, do they pay a dividend? They're only paying out 8% of the pie of the net income. When we look at the coverage ratio, still high like the other one we talked about. How much do they pay out in terms of per share trailing 12 months? It's only 82 cents. Now, that's not negative. The company might say, look, instead of paying out the dividend, we want to actually use that money that we're making to reinvest it back into the business. Why do we bring up Google? Now, there are some technicians that the word flag is the most overused word in the English language. Now, if Barbara Armstrong was here, she says fleeg. And what we take a look at here, some investors might say, hey, you know what? We see this stock where it's had a little run to the upside. Now, by the way, I do want to note something here. This was the old resistance, 291. Why is this stock not coming back down to where? Now, if some of you are asking, James, what did you do with those Canadian fleegs? Well, I gave them out to people who did Halloween trick-or-treating. Kids were asking, why do I get a flag? Where's my candy? Okay, told them be happy with the Canadian fleeg and just enjoy it. The biggest actually thing, they're good neighbors. The biggest actually thing is when you look at this, why did it pull back? Well, some investors, if there are people that are in this, they might not want to sell it. Second, if they are selling it, people are trying to get in. And they're saying, look, I want to get in. I don't think it's going to come down to the 290 they might be thinking. Now, when we look at something like this, I'm going to right-click on this chart. And what I'm going to do is I'm going to do an order called a buy stop limit. So have you ever looked at a chart and said to yourself, I'm not ready to buy, but, if it did this, that's when I would get in. Now, what type of order is that? Well, we're going to go to buy custom with OCO bracket. Now, I'm telling you, I'm not going to pull my hair out because any of the hair I have, I want to keep it there. Okay? This is 100% real, by the way. Now, if we take a look at this for just a second, wherever I right-clicked on the chart, wherever I did, that's the price there. Now, what we're going to say is, look, if we go up to 321 and change, get in. However, the con about that order is, well, how do you know if it gaps up to 350? I mean, we don't have a ceiling on what it's going to buy it for. So we're now going to change this to buy stop limit. Now, what we're going to say is, look, you're allowed to buy within a bracket. Now, think of this like field goal, okay? But instead of this actually being like a field goal, it's actually turned sideways, okay? So if we actually said, look, buy if we get at or above this price, but no higher than 321. Well, that band, that field goal post, so to say, is only $1 wide. So it's allowed to buy up to 322.18, but no higher, okay? But the key is it has to go to 321.18 or higher, but no more than 322.18. But what if we did 321.19? Well, again, think about like that field goal post. Man, the tighter those numbers are, the lesser the chance that it could actually get filled. So that's why we kind of spread it out just a hair so we have a greater chance to make it potentially get filled. Perhaps. We're going to find out. And now I'm not going to do a timestamp here, but if you said, James, I want to see a timestamp where you say, look, send this order in, let's say, the last hour of trading. So what I'm going to do, or the last 15 minutes. Now, why are you saying that now? Well, we got the Fed today, okay? And we're going to say, look, in the last 15 minutes of the market, this is based on my time zone. I'm going to say in the last 15 minutes, if the stock is at or above that price, but no higher than what we said, try to get the order filled. Get past what the Fed is going to say and so on, and try to see if that stock is going to fill. Now, so it's timestamped for today, the last 15 minutes based on my time zone. The target price, let's go back to Fibonacci, our good friend here, okay? You thought math doesn't apply to you, but it does if you're a technician. If we go back to this and said, what is that extension target? That extension target is right at 361.16. Now we want to kind of now be thinking to ourselves, well, what is that potential stop to the downside? Well, that stop to the downside could be that horizontal support, and that horizontal support is right around 312.84. Okay? Well, if we did less 2%, it's going to be 306.58. 306.58. Now remember, I'm not thinking about dollar amount because it's a $300 stock. 306, 306.58, check. So if I took those numbers and said, I'm thinking about percentage. If we get filled at the highest price and we get stopped out at 306.58, which has an assumption to it, we talked about that, it's $15 per share. $15 per share on a $322 stock is what percent? It's 4.8%. So when you express it in a percent, it's really not, it's not even as high as the WDC example. So trade number one we did was WDC. Trade number two we did actually was Seagate. Trade number three that we looked at was Google. Now, when we come into earnings in closing, this is why the earnings is so important of the company, because it's really reconfirming that their forecast, that they're on track to hit the forecast. Or are there changes to the forecast? Or are they lagging the forecast? Okay, so the earnings really kind of gives us an update of where they are in that forecast that they had. And are there changes? Okay, now what I want you to do for homework is I want you to choose between A, B, or C stock. You get to choose, okay? Then what I want you to do is I want you to look at some of those metrics, A, B, or C, whichever ones that you like to look at, that you think for you have more meaning, you get to choose. Now, what I want to also quickly remind us at here today is quickly reminder, this link that I'm going to send by the way, that position size, it's going to be $4,000, $4,000 worth of stock, $4,000 worth of stock. Let's type the numbers in so we can be consistent, not start the year off talking about it. And the end of the year, we don't even say it anymore. It's going to be 12 shares. So 12 shares, we'll finish that right there, 12 shares. Now, reminder with the link that I just sent to you, that's for tomorrow night at 7 p.m. Eastern. Join us there. You can link to that right there, or you can actually just be on the Thinkorswim platform, go to the Trader TV, and it will hyperlink as well to the Schwab Network. Join us. Now, remember, coming up next, we got a class by Michael Fairborn on managing an option portfolio. We have Scott Thompson with us here. He is also doing the class on getting started, the stock investing for beginners. Join him as well there. Thank you so much for your comments and your participation. And always remember, you can just go to YouTube and click on the Trader Talks Schwab Coaching Webcast and subscribe for free. Okay, so if you haven't done that, do it today. Now, also remember with what we discussed, it was done for example, illustrative purposes only. We talked about the risk of stops and we talked about those scenarios. Now, remember when you could join us on these classes throughout the day and throughout the week. This is not one-off. These are live classes. Thank you so much. Take care and bye-bye.